February 6th, 2025. A single trader in Shanghai held a short position so massive it exceeded the entire reported inventory of one of the world's largest silver exchanges. Then, without warning, the position was frozen. The official explanation? Routine volatility management. But here's what they're not telling anyone. 3 major financial institutions quietly reduced their silver exposure by 40% in the preceding 72 hours. Physical delivery requests spiked to levels not seen since 2011. And the gold-to-silver ratio just flashed a signal that has preceded every major monetary crisis in the past century. What happens next isn't just about silver, it's about what silver is trying to tell us. Welcome to Silver Radar. Now, before we go any further into what's really happening here, may I ask you for a small favor? You know how we used to keep important phone numbers written down in a little book, just in case we needed them? Well, that subscribe button right there works the same way. One click, and you'll never miss an update when these markets move. We'd be honored if you'd do that now. And please, drop a comment telling us where in the world you're watching from today. Are you in London, Mumbai, São Paulo? We want to know whose financial future we're helping protect. Now then, let's talk about what's really happening in the silver market and why the next 30 days could change everything. On the morning of February 6th, 2025, in a nondescript trading floor in Shanghai, something extraordinary occurred that most of the world would never hear about. A position was frozen, not reduced, not margin called, not unwound through normal market mechanisms. Frozen entirely. The Shanghai Futures Exchange issued a terse statement that afternoon, barely 3 sentences long, explaining that regulatory measures had been implemented on a single account due to abnormal trading activity and risk management concerns. What they didn't explain was the size. According to sources within the exchange's clearinghouse operations, this single trader had accumulated a short position representing approximately 180 million ounces of silver. To put that in perspective, that's roughly equivalent to 1/5 of total annual global silver mine production. And here's where the mathematics become uncomfortable. The Shanghai Futures Exchange reported holding just 210 million ounces in registered warehouse inventory at the time of the freeze. One account, one trader, one position, representing 85% of the exchange's entire reported physical backing. This isn't routine volatility management. This is what happens when the paper market and the physical market stop pretending to be the same thing. Now, the official narrative being circulated through financial media channels emphasizes market stability measures, routine procedures, nothing to cause alarm. But those who understand how commodity exchanges actually function recognize what this freeze represents. It represents an admission that someone, somewhere, accumulated a position so large that allowing it to continue posed an existential threat to the exchange itself. Because here's what most people don't understand about modern commodity markets. There's a photograph that hangs in the Bank of England archives, barely noticed by the tourists who pass through, showing 8 men seated around a mahogany table in November of 1961. They're smiling, they're confident. They're representatives of the world's most powerful central banks, and they've just agreed to do something they believed would be simple. They decided to control the price of gold. For 7 years, they sold physical gold into the market every time the price threatened to rise above $35 per ounce. They called it the London Gold Pool, and they were absolutely certain they could maintain control indefinitely. By March of 1968, the pool had collapsed. The demand for physical metal had overwhelmed their ability to supply it, and the entire arrangement disintegrated in a matter of weeks. The price of gold subsequently rose from $35 to over $800 within 12 years. That photograph is relevant today because what failed in 1968 didn't disappear. It evolved. The lesson central banks and major financial institutions learned from the London Gold Pool was not that price suppression doesn't work. The lesson they learned was that you can't suppress prices by selling physical metal you actually have to deliver. So they built something more sophisticated. They built a derivatives market so vast and so complex that price discovery moved entirely away from physical transactions and into the realm of paper contracts. Today, the spot price of silver is not determined by someone buying a bar of silver from a refinery in Switzerland. It's determined by contracts traded on exchanges where actual delivery represents less than 2% of total volume. This isn't conspiracy theory. This is documented market structure. The Bank for International Settlements reports that the total notional value of over-the-counter precious metals derivatives exceeds $1 trillion. To put that in context, total annual silver production is worth roughly $14 billion. The paper market is 70 times larger than the entire year's physical supply. Now here's where this becomes relevant to what happened in Shanghai. The concentration of these derivative positions isn't distributed across thousands of small traders making independent decisions. It's concentrated among fewer than 10 major financial institutions who act as market makers and bullion banks. These institutions hold both long and short positions. But the net short position, the amount by which their sales exceed their holdings, has grown consistently for the past 15 years. The Office of the Comptroller of the Currency in the United States publishes quarterly reports on bank derivatives exposure. The most recent report shows that just 4 banks hold 91% of all precious metals derivatives in the U.S. banking system. 4 banks, controlling the paper market that determines the price of physical metal. This concentration creates enormous leverage, but it also creates enormous risk. Because unlike other derivatives, markets where the underlying asset might be a stock or a bond or a currency, precious metals derivatives ultimately reference something physical, something that has to actually exist if delivery is ever demanded. There's a photograph that hangs in the Bank of England archives, barely noticed by the tourists who pass through, showing 8 men seated around a mahogany table in November of 1961. They're smiling, they're confident. They're representatives of the world's most powerful central banks, and they've just agreed to do something they believed would be simple. They decided to control the price of gold. For 7 years, they sold physical gold into the market every time the price threatened to rise above $35 per ounce. They called it the London Gold Pool, and they were absolutely certain they could maintain control indefinitely. By March of 1968, the pool had collapsed. The demand for physical metal had overwhelmed their ability to supply it, and the entire arrangement disintegrated in a matter of weeks. The price of gold subsequently rose from $35 to over $800 within 12 years. That photograph is relevant today because what failed in 1968 didn't disappear. It evolved. The lesson central banks and major financial institutions learned from the London Gold Pool was not that price suppression doesn't work. The lesson they learned was that you can't suppress prices by selling physical metal, you actually have to deliver. So they built something more sophisticated. They built a derivatives market so vast and so complex that price discovery moved entirely away from physical transactions and into the realm of paper contracts. Today, the spot price of silver is not determined by someone buying a bar of silver from a refinery in Switzerland. It's determined by contracts traded on exchanges where actual delivery represents less than 2% of total volume. This isn't conspiracy theory. This is documented market structure. The Bank for International Settlements reports that the total notional value of over-the-counter precious metals derivatives exceeds $1 trillion. To put that in context, total annual silver production is worth roughly $14 billion. The paper market is 70 times larger than the entire year's physical supply. Now here's where this becomes relevant to what happened in Shanghai. The concentration of these derivative positions isn't distributed across thousands of small traders making independent decisions. It's concentrated among fewer than 10 major financial institutions who act as market makers and bullion banks. These institutions hold both long and short positions. But the net short position, the amount by which their sales exceed their holdings, has grown consistently for the past 15 years. The Office of the Comptroller of the Currency in the United States publishes quarterly reports on bank derivatives exposure. The most recent report shows that just 4 banks hold 91% of all precious metals derivatives in the U.S. banking system. 4 banks, controlling the paper market that determines the price of physical metal. This concentration creates enormous leverage, but it also creates enormous risk. Because unlike other derivatives, markets where the underlying asset might be a stock or a bond or a currency, precious metals derivatives ultimately reference something physical, something that has to actually exist if delivery is ever demanded. The incentive structure for maintaining this arrangement is straightforward when you understand what's at stake. Precious metals, particularly silver and gold, represent alternative stores of value to fiat currency systems. When confidence in paper currencies declines, when inflation accelerates, when sovereign debt reaches unsustainable levels, capital flows into precious metals. This creates a problem for central banks managing monetary policy and governments financing deficit spending. Rising precious metals prices signal a declining confidence in the monetary system itself. So there exists a structural incentive, not spoken about in official policy statements, but evident in market behavior, to prevent precious metals prices from rising too quickly or too visibly. This isn't achieved through conspiracy in smoke-filled rooms. It's achieved through the normal operations of a derivatives market where the largest players have aligned interests. When silver prices begin to rise, additional paper supply can be introduced into futures markets through increased short positions. This creates downward price pressure without requiring anyone to sell actual physical metal. It's elegant, it's legal, and it works, right up until physical demand exceeds the system's ability to deliver. There's historical precedent for what happens when paper markets diverge too far from physical reality. In January of 2021, Several Reddit forums organized a coordinated purchasing campaign of physical silver, believing the market was artificially suppressed. Within 72 hours, premiums on physical silver coins and bars spiked to 40% above spot price. Delivery times extended to 12 weeks. Several major dealers suspended sales entirely, claiming they couldn't source inventory. Yet the spot price, the official price determined by futures markets, barely moved. This revealed something critical. The paper price and the physical price had decoupled. You couldn't actually buy silver at the spot price. The official number had become a fiction, a number on a screen that bore a decreasing relationship to what people would actually pay for metal in hand. The situation resolved only when buying pressure subsided and the physical market returned to normal premiums. But the vulnerability had been exposed. The February 6th freeze in Shanghai represents the same dynamic, but from the opposite direction. Instead of a buying squeeze revealing insufficient physical supply, this is a short squeeze revealing excessive paper supply. Someone built a position so large that the exchange recognized it as a systemic threat. And the question that now hangs over the entire global silver market is simple. If Shanghai felt compelled to freeze one account, how many other accounts across how many other exchanges are carrying similar positions? How much of the paper silver market represents real metal? And how much represents promises that cannot possibly be kept if delivery is ever demanded? There's a moment in every complex system when multiple small failures converge into something catastrophic. Engineers call it cascade failure. Epidemiologists call it exponential spread. Economists call it contagion. Whatever the terminology, the principle remains the same. Individual weaknesses that seem manageable in isolation become devastating when they interact. The global silver market is currently experiencing the early stages of exactly this phenomenon, and the Shanghai freeze isn't the cause. It's a symptom of something far more fundamental breaking down. To understand what is actually happening right now requires looking beyond silver itself and examining the macroeconomic environment in which this market stress is occurring. Because what makes the current situation uniquely dangerous isn't just the size of the frozen position, it's the timing. Global sovereign debt has reached levels that would have been considered mathematically impossible 3 decades ago. The combined government debt of the G7 nations now exceeds 125% of their collective GDP. Japan's debt-to-GDP ratio sits above 260%. The United States is adding approximately $2 trillion to its national debt annually. Italy, France, and the United Kingdom are all running deficits that require continuous bond market absorption of new issuance. This matters to silver markets because of a relationship most economic commentary ignores. When sovereign debt reaches extreme levels, governments face a choice. They can implement austerity measures that contract the economy and risk social instability. They can default outright and destroy confidence in their credit markets. Or they can pursue monetary policies that gradually devalue the currency through inflation, making the debt easier to service in nominal terms while eroding purchasing power. History shows that governments almost always choose the third option. And when currency devaluation becomes the unstated policy objective, precious metals become the most visible indicator of what's really happening. Rising gold and silver prices don't just reflect inflation, they reflect declining confidence in the monetary system itself. They become a referendum on whether people trust the paper. This creates what game theorists would call a strategic dilemma for central banks and major financial institutions. They need inflation to erode debt burdens, but they can't allow precious metals prices to rise so dramatically that they trigger a loss of confidence in fiat currencies. The solution has been the derivatives market structure described earlier, maintaining enough paper supply in futures markets to prevent prices from rising too quickly, regardless of physical supply and demand fundamentals. But this strategy has a breaking point. And that breaking point arrives when physical demand exceeds the system's ability to deliver actual metal at the suppressed paper price. The current macroeconomic environment is creating exactly that condition. Real interest rates, the nominal interest rate minus the inflation rate, have been negative across most developed economies for extended periods. When holding cash guarantees a loss of purchasing power, investors seek alternatives. Historically, precious metals have been the primary alternative store of value during such periods. The result is increased demand for physical metal at exactly the moment when the paper market structure is most vulnerable. Now add the supply side equation. Silver production has been essentially flat for the past 5 years despite rising prices. Most silver is produced as a byproduct of copper, lead, and zinc mining, which means silver supply doesn't respond to silver prices the way primary metal production would. Meanwhile, industrial demand for silver continues to grow. Solar panel production alone now consumes approximately 20% of annual silver supply, and that percentage is increasing as renewable energy deployment accelerates. Electric vehicles use twice as much silver as internal combustion vehicles. 5G infrastructure requires significantly more silver than previous generation telecommunications. Defense applications, particularly in electronic warfare systems, have become major silver consumers. This isn't speculative future demand. This is current, ongoing industrial consumption that must be satisfied with physical metal. You cannot build a solar panel with a silver futures contract. You cannot manufacture a missile guidance system with a paper claim on silver. Industrial users need actual metal, and increasingly, they're competing with investment demand for a supply that isn't growing. The warehouse stock data tells the story that official price charts obscure. COMEX registered silver inventory, the metal actually available for delivery against futures contracts, has declined by 38% over the past 18 months. London Bullion Market Association vault holdings have dropped by 22% during the same period. Shanghai Futures Exchange stocks, as mentioned earlier, stood at just 210 million ounces when the freeze occurred, down from over 400 million ounces in 2020. These aren't abstract numbers. They represent the physical backing for a derivatives market that claims to represent billions of ounces. The ratio of paper claims to physical metal has been rising steadily, and it's now approaching levels that some analysts consider structurally unstable. When asked what happens if even 5% of paper silver holders simultaneously demand physical delivery, one senior bullion banker who spoke on condition of anonymity replied simply, "The system stops working." That's not hyperbole, that's mathematics. The metal doesn't exist in sufficient quantity to satisfy the claims. What makes the current situation particularly precarious is the behavior of sophisticated institutional players who understand this dynamic. Sovereign wealth funds have been accumulating physical precious metals at rates not seen since the 2008 financial crisis. Central banks, particularly those of Russia, China, Turkey, and India, have been adding to gold reserves while quietly securing silver supply chains. These are not retail investors responding to YouTube videos. These are professional treasury managers with access to the same data being examined here, and they're choosing physical metal over paper claims. Their behavior suggests they understand something important. They understand that in a genuine crisis, paper claims become subject to force majeure provisions, delivery delays, cash settlement clauses, and exchange-imposed position limits. Physical metal in a secure vault isn't subject to any of those risks. The divergence between institutional behavior and public messaging has become stark. Official statements emphasize market stability and adequate liquidity. Meanwhile, the largest and most sophisticated players in the global financial system are quietly positioning for the opposite. This divergence is itself a signal. When central banks accumulate physical metal while major commercial banks maintain a massive short positions in derivatives markets, someone is wrong about what happens next. The question facing anyone trying to interpret current events is simple. Which group is making the correct assessment? The institutions accumulating physical metal, or the institutions maintaining paper short positions that depend on delivery never being demanded? The Shanghai freeze suggests that question is about to be answered, whether anyone is ready for the answer or not. The difference between a warning and a prediction is that a warning requires no certainty about specific outcomes, only recognition that current conditions have created unacceptable levels of risk. What occurred in Shanghai on February 6th doesn't tell us exactly what happens next. It tells us that the system designed to manage silver market pricing is encountering stress levels that force visible intervention. Invisible intervention in normally opaque derivatives markets represents a threshold being crossed. The question for business leaders, institutional decision makers, and anyone responsible for capital allocation is not whether to panic. It's whether to recognize that the risk-reward calculations that seemed reasonable 6 months ago may no longer apply to current conditions. There are scenarios that can unfold from here, and understanding each requires looking at what the data is actually showing rather than what official statements claim. Scenario 1 assumes the Shanghai freeze represents successful containment. In this interpretation, regulators identified an over-leveraged position, implemented emergency measures before it could destabilize the broader market, and the account will be unwound gradually over coming weeks without triggering contagion. Other exchanges and clearinghouses review their exposure, implement additional risk controls, and the market returns to normal functioning. This scenario requires several conditions to hold true. It requires that the frozen position was genuinely unique rather than representative of broader positioning across multiple accounts and exchanges. It requires that physical supply remains adequate to meet delivery demands at current price levels. And it requires that the macroeconomic conditions driving increased precious metals demand don't intensify. The probability of this scenario can be assessed by monitoring whether warehouse stocks stabilize, whether other exchanges implement similar freezes on additional accounts, and whether physical premiums return to historical norms. If 3 months from now, registered inventory has recovered, delivery delays have normalized, and no additional emergency measures have been implemented, the scenario will have proven correct. Scenario 2 represents partial system failure, where the Shanghai freeze is revealed as the first visible crack in a much larger problem. In this scenario, the account frozen in Shanghai is discovered to be one of multiple over-leveraged positions across different exchanges. As awareness spreads, other large short position holders attempt to reduce exposure simultaneously, creating a self-reinforcing spiral. Exchanges implement additional position limits and margin requirements. Some accounts that cannot meet increased margin calls are liquidated, forcing buy-side pressure that drives prices higher. Rising prices trigger stop-loss orders on other short positions, creating classic short squeeze dynamics. Physical delivery demands increase as paper market participants lose confidence in the ability to actually receive metal against contracts. Premiums on physical metal spike to levels that effectively create a two-tier market. A paper price that continues trading on exchanges, and a physical price that reflects what metal actually costs when delivery is required. This scenario would manifest through specific observable indicators. Physical premiums would expand beyond 20% over spot price and remain elevated. Major dealers would implement allocation systems or suspend retail sales entirely. Lease rates for borrowing physical metal would spike to double-digit percentages. Exchange open interest would decline significantly as positions are closed rather than rolled forward. And most tellingly, other exchanges beyond Shanghai would implement emergency measures, including position limits, increased margins, or forced liquidations. Scenario 3 represents coordinated intervention across multiple jurisdictions to prevent the Scenario 2 outcome from materializing. In this interpretation, the Shanghai freeze serves as a signal to other regulatory bodies and central banks that the derivatives market has become systemically unstable. Rather than allowing market forces to unwind over-leveraged positions through price discovery, authorities implement coordinated measures to maintain control. This could include forced cash settlement of contracts rather than physical delivery, temporary suspension of trading during extreme volatility, implementation of position limits that prevent large holders from demanding delivery, or even direct intervention in physical markets through central bank sales or leasing arrangements. This scenario would be the most difficult to identify in real time because official communications would emphasize market stability and routine regulatory oversight, rather than acknowledging coordinated intervention. However, certain signatures would be observable. Futures contract specifications might be modified to make physical delivery more difficult or expensive. Clearinghouses might implement new rules around delivery procedures that effectively discourage taking physical possession. And most significantly, there would be increasing divergence between official spot prices and the actual prices at which physical metal trades hands in size. History provides guidance here. During the March 2020 financial crisis, gold futures contracts traded at unprecedented premiums to spot prices because physical delivery became nearly impossible due to refinery closures and transportation disruptions. The official price and the actual price decoupled entirely for several weeks. Similar dynamics could emerge in silver if stress continues. For those responsible for making decisions based on this analysis, several specific indicators warrant close monitoring. First, watch exchange inventory data from COMEX, Shanghai Futures Exchange, and London Bullion Market Association vaults. If registered stocks continue declining while open interest remains elevated or increases, the ratio of claims to physical metal is worsening. Second, monitor the spread between physical premiums and paper prices. When 1,000-ounce bars trade at premiums exceeding 10% above futures prices, it signals physical market stress. When premiums exceed 20%, it signals breakdown of normal arbitrage mechanisms. Third, observe institutional behavior through regulatory filings. When major banks reduce derivatives exposure or when sovereign entities increase physical holdings, these actions reveal how the most sophisticated players are positioning. Fourth, track lease rates and borrowing costs for physical metal. When it becomes expensive or impossible to borrow silver for short-term delivery, it indicates physical tightness that paper prices may not reflect. The implications for businesses vary by exposure type. Companies that use silver as an input for manufacturing face potential supply disruptions and price volatility that could render fixed-price contracts unprofitable. Locking in physical supply through long-term agreements with refineries or major dealers may be worth the cost even at premium prices if it guarantees production continuity. Financial institutions holding precious metals derivatives as part of trading books or risk management strategies should be modeling extreme scenarios where correlation assumptions break down and where counterparty risk becomes material. The assumption that contracts can always be closed at reasonable prices or that physical delivery is a theoretical rather than practical concern may no longer hold. For wealth managers and institutional investors, the question is whether precious metals allocation provides genuine portfolio protection or whether paper exposure through ETFs and futures carries risks that defeat the purpose of holding metals as insurance. The answer increasingly appears to be that physical possession, despite storage costs and liquidity constraints, represents meaningfully different risk characteristics than paper claims. What the silver market is demonstrating right now extends beyond one commodity. It reveals how derivative markets that have grown far larger than the underlying physical markets they reference can create systemic fragility. It demonstrates how interventions intended to maintain stability can instead signal to market participants that the system requires intervention to function, which itself undermines confidence. And it shows how macroeconomic conditions, characterized by extreme debt levels, negative real interest rates, and currency devaluation, create demand dynamics that stress market structures designed for different environments. The Shanghai freeze didn't create these conditions, it revealed them. And what happens next depends not on prediction, but on recognition. Recognition that the gap between paper pricing and physical reality has widened to proportions that may not be sustainable. Recognition that the largest and most sophisticated institutional players are positioning for outcomes that differ significantly from official narratives. And recognition that in markets where leverage and concentration have reached extreme levels, the difference between contained risk and cascade failure can be measured in days rather than months. The warning has been issued, the data is available. What decision makers choose to do with that information, that's what happens next.